The Rebel Capitalist Show. All right, guys, it gives me a great deal of pleasure to bring someone back to the Rebel Capitalist Show that I really enjoy talking to. He is the host of the Quoth The Raven podcast. His name is Chris Irons. Chris, welcome back to the show.
What's up, George? How are you?
I'm doing well. I'm here quarantined in Colombia, but other than that, doing extremely well. Dude, we got a lot to talk about.
I know. And listen, off the bat, I want to apologize because the last podcast that we did, I was screaming quite a bit and my laptop microphone was distorting everything. And so when I went back to listen to it, the whole thing was basically a waste. So right. I got a special new microphone here specifically so I don't ruin your whole show. And I'm going to try not to scream, but I'm not making any promises.
No, it's all about the content. It's all about the content. So first thing I want you to talk about is just the unemployment numbers and the market's reaction to those unemployment numbers.
Yeah, well, I mean, what do you expect from a stock market that is completely disconnected from the economy and completely disconnected, from any type of fundamentals? And that's not by accident, right? What the Fed is doing here in response to this coronavirus panic and basically the economy going from 100% to 0% in a matter of just days, which, by the way, you were one of the only people that recognized this well in advance. But essentially what the Fed has decided is that, remember Mythbusters when the guy's like, I reject your reality and I substitute my own? That's what the Fed's doing with the economy. They reject what's going on. They reject the truth, the objective truth, the unemployment numbers, the production grinding to a halt, people staying at home, spending drying up. They're rejecting that and just saying, here's Neil Kashkari, who we could talk about that interview at some point too.
60 minutes.
He's going to print $5 trillion and like they're changing a fucking tire on a car that's going down the highway, right? We're just going to take the tire off and put the donut on while we're doing 90 down the road and hope that the car doesn't veer off the road and that there's no consequences. So what are you supposed to expect? I mean, the market rallied this morning because the job loss figure was 3 million because which is 13 times what it normally would have been around this time. But because it wasn't 5 million or 6 million, that's positive news. And that is a perfect example of what the Fed has turned the capital markets into, which is completely disconnected from reality and really a very sad joke, a very sad laughing stock. And the Fed has just said, we're gonna take fiat to the end of the world, like that Seinfeld episode where George just keeps driving. He's telling Susan's parents he's got a house in the Hamptons, and he just keeps going and going. And they're like, where is this house, George? And he's like, we're going to get there, they just keep going, and they're not going to stop until they have completely destroyed the dollar or have learned the hard way through a total confidence loss, which, by the way, I don't think we're that far from. So does it surprise me that the jobs number of 3.2 million had the market rally this morning? No, because you're dealing with widgets and leprechauns and unicorns. What's the ratio of one to the other? Who knows? Gold's going up. That's all I fucking know.
Yeah. You understand the bottoms up analysis and the data of the market so much better than I do on a day-to-day basis. But I don't. What I'm having a hard time understanding is I get it that the liquidity injections, the Fed comes in, it's kind of there's no price discovery, who knows why it's going up, but I would have assumed that the job expectations being, what were they, 1.5 in job losses, and the fact that we have 3.3, it's double what expectations are. So doesn't that make the market go down? I mean, I would have understood if the expectations were 6 million and it comes in at 3 million, then okay, great, that's better than we expected. But it seems like it's worse than expected and it still goes up. Am I seeing that correctly?
Well, I was hearing whisper numbers of 5 million, 6
Okay.
million. So I think what I think happened is I think people are seeing the 3 million number as a beat, which is
All right.
perverse. I mean, that's sick. But I think that's what happened. And just to go back to what you just said a second ago about like you don't really understand why the market keeps going up, I'm gonna make it very simple, right? And not just for you, but for everybody. The Fed has made it abundantly clear that the stock market going up is the only thing they're focused on. Forget the fucking dual mandate, forget price stability. They don't care about anything aside from backstopping the stock market. That is it. And whatever variables need to be tweaked and whatever needs to be done in order to make sure that that happens, they're going to do. So they're going to ruin a lot of things in the process. They'll ruin the currency. They're going to, they're going to buy the entire bond market. I mean, they're going to do all of these things, but as long as the market is going up and the optics of things are okay, I think that's the only thing they care about. And I don't really know what
the Fed put. Is it the Fed put though? Because it seems like the Fed put is kind of expired, and everything that they did, whether it's QE Infinity or any of the 5-letter, 4-letter programs they've come up with, the market kind of went up initially for the first hour, then it tanks. So it's like, okay, we're not taking this anymore. So is it the Fed put back in play, or do you think it's the market now looking at fiscal stimulus and saying, okay, this is what we needed all along? And I'm not saying that's right.
Well, it's probably both, but I think what's happening is the Fed is bearing a lot of the liability and a lot of the risk. I mean, I don't think it's, technically, it's not technically a liquidity issue. It's taking risk off of people's books, and that's what they're doing. And so by backstopping all of that risk and taking all of this toxic dog shit and putting it on the Fed's balance sheet instead of where it's supposed to be, they're essentially giving oxygen to the flame that's fueling the equity market rally. So I don't really know, to be honest with you. It's a very strange set of circumstances, but now they're buying corporate bonds and they're buying municipal bonds. And I saw we got one step closer to them admitting that they're going to buy stocks. They were buying corporate bond ETFs, and I have long prognosticated that the Fed, if they're not buying stocks or futures already, which I'm not convinced that they aren't, will be very soon in the future. And I think that's the next thing to happen. And I think they're just going to take it as far as they can take it until they can't anymore. And by that point, it will be devastation. And that's worrisome. But, in terms of what's fueling the market now, they're bearing all of this risk, right, George? Like all of the defaults and all of the things that are supposed to happen that normally would happen, the bankruptcies, they're bearing all of that risk. They're saying all this stuff is off the table for now. Which is why you see this ridiculous shit like Cheesecake Factory coming out yesterday and saying, we're just not paying our rent anymore. And people are looking at that like, what are you talking about? Like, well, we just told our landlords, we're going to stay in the buildings. We're just not going to pay our rent anymore. It's like, that's not how that works. So that is what happens when you backstop all of this risk. What an economy used to be and the transactions that used to make up a working productive economy start going like ass backwards and sideways. It's like the bizarro world. And that's what the Fed has enabled to happen here. So
but I want to unpack why they can do that, just because the average viewer will hear that, they'll instinctively get it. But the reason the Cheesecake Factory, as an example, is just telling their landlord to pound sand and they just want to stay open is because they go to the Fed through I don't know how they go through one of their new programs that they've set up, and the Fed gives them money to stay in business. They basically give them a bailout. People say, oh, no, it's not a bailout, it's just a loan. Well, yeah, but it's a loan at 0% interest, where they'll most likely be able to roll over indefinitely. So is that really a loan at the end of the day? And so they're getting all of this funding, all of this cash, all of these newly printed, funny money, whatever you want to call it, and it's going to the corporations. And so they're taking this and saying, well, man, why do we even need to serve customers? It's kind of it's kind of a pain in the butt. Why don't we just take all
Right.
this money from the Fed and survive on this because we don't really have to pay it back, and then we don't have to pay our landlord because we'll just use the cerveza sickness as an excuse, and they're living large, right?
That's
So
it. That's your
that's
new business model, right?
yeah. I just want you to maybe expand on that, but I just wanted to quickly explain that to the viewer or the listener who might not have been able to connect those dots. And it's all about these new programs and facilities. One thing I'd like you to touch on, just reminded me, is if I'm understanding it correctly, prior to last week, when you had mentioned to someone in the established media realm, hey, I think the Fed's going to buy stocks, or I think they're going to buy corporate bonds, they say, no, 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 that's impossible because of this law, and it's got to be an act of Congress. Can
I
you
love
explain
this.
that a little bit more?
Yeah. Well, first off, to go back to, expanding a little bit more on what's going on with the Cheesecake Factory example, it's insane. I mean, everything that we know about business and productivity and how a business is supposed to generate cash for itself so it can reinvest in itself, and what a business's incentive is to serve customers and to make sure that people are happy when they come in and that they're getting a quality product, and all of these, like, you know, community college econ 101 business rules that are at the core of how capitalism works are discarded when the Fed comes in and says we're just going to backstop all of your risk. I mean, and that's essentially what's happening. So that's why, I mean, you thought it was unprecedented when they were just, adding liquidity to the repo facilities overnight and stuff. And this is like an entire substitution of a whole economy.
Right.
And you remove all the incentives for people to go back to work. I mean, they're specifically trying to do that to quarantine people, which I don't think is a terrible idea. But it's definitely like we're going to see some really strange stuff. This is going to be unprecedented, and it's going to be a weird shift to go back to how, I mean, we didn't really even have free market capitalism before this. We had more of it than what we have right now, and now we have more of it than we're going to have in 2 weeks, 3 weeks. But it's going to be interesting watching all these businesses try to get back. And the fact of the matter is, there's going to be companies that go bankrupt. I mean, the Fed isn't backstocking everybody. They're not buying everybody's corporate bonds. They just can't. It's not a matter of they don't have the money. It's a matter of administrative tasks. They're not going to be able to reach out to every small and medium-sized business everywhere. So there's companies all over the place, especially ones that have a lot of leverage, that are going to go out of business because of this, and they're going to go through bankruptcy. And like I was just telling my friend today, bankruptcy is not a bad thing. People think of bankruptcy as, like when the president talks about Boeing and the president talks about American Airlines, he says, we can't let these companies go bankrupt. We have to protect them. And what they don't understand is bankruptcy is what's supposed to happen when a company cannot endure the environment around it. It either wasn't built for it or it wasn't prepared to sustain the environment like that we're in now. So for instance, everybody keeps saying, oh, these companies should have saved for a rainy day. Then they'd have money in the bank and they'd be able to endure a little bit more of this than if they had taken all their free cash and bought back their stock at a multiple that's, 3 times higher than it should be. Bad use of capital, right? So what bankruptcy does is, and people don't understand, people think if American Airlines goes bankrupt, the airplanes just disappear and everybody stops traveling and the airports shut down. And like, that's not what happens. All bankruptcy is it's a restructuring of a company's debt, 9 times out of 10, unless they're going to liquidate. But for the most part, you're just restructuring liabilities. And then I think even Peter Schiff said this on his podcast a couple of days ago. They can have a more competent management team come in and not repeat the mistakes of the past management team. So this fear that the Fed has and that the government has and our president has of we can't let companies go bankrupt, not only does it create an enormous moral hazard, but it throws the whole economic system way out of whack. And just the most recent example was yesterday, somebody had put on Twitter, oh, maybe we shouldn't even post the jobs number. Maybe we should, who was it? I can't remember who it was. It was like
It was
Krugman
it
or
wasn't just a
Kramer.
it was an actual like famous
I don't
person.
think it. I don't. Yeah, I don't think it was Krugman. Maybe it was the CNBC anchor.
Uh,
But anyways, I tweeted about it, and somebody said, maybe we should hold off on the economic. Who the hell was it?
hmm,
It was. I can't remember. It's gonna come to me. But they posted. Maybe we should just hold off on posting the unemployment number. It's like you can't do that. You can't just ignore data when it doesn't go the way that you want it to. First off,
exactly.
it's extremely dangerous, right? Because then you start building up more of a false sense of hope than we already had going into this mess, which is why so many people were shocked by it to begin with. But you can't do that. You can't just take your ball and go home when the debt, that's not the purpose of macroeconomic data. The purpose is to have an objective gauge on how things are going, which is why, what little bit of credit I can give them, A, they kept the markets open, which is good, even though they're rigging them. But B, they put out the jobs number too. Oh, you know what it was? It was somebody that said the SEC shouldn't require companies to file first quarter earnings. That's what it was. And it's same deal, same
Wow.
situation. It's like, we got to know what the numbers are. We know they're going to be shit. Everybody in the world knows they're going to be bad. Everybody knows the economy has ground to a halt here. Nobody expects anybody to, break through with some incredible Q1. Give us the numbers. We can handle it and we'll make our decisions accordingly. But not allowing those disclosures to come to market for Q1 numbers for companies is far more dangerous, because then people get completely lost, and what little price discovery we have left, which, as you know, George, is very, very little. Even that they don't even have a little string to just hold on to try to figure out whether or not they're in the right place. So it's very dangerous, and it's a huge moral hazard.
Yeah, people really forget how much information is in a price. And it's absolutely everything. And I always say that if the price of money is an interest rate, and the Fed is artificially manipulating interest rates, and money is one half of every transaction, then basically there is no price discovery, because every price is manipulated by the Fed.
Right. The price is discovered, and then everything else adjusts around it.
At what point do you personally get bullish on the S&P, and why?
So this is an interesting question, right? Because it's like, the problem with trying to get bullish on stocks is you have game theory layered upon game theory layered upon game theory, right? So in an ideal world, the way that the market's supposed to work is you're supposed to be essentially discounting a company's future earnings and then trying to decide whether or not that's baked into a stock price now at a multiple that you think it creates a value, right? But we don't have that anymore. So there's no real discovery. There's nothing. I honestly, I look at the economy and the market as almost completely disconnected. I mean, you look at companies like Tesla and what's the other one, Virgin Galactic, and it doesn't matter. They don't have any business. They're not generating any cash. They're not making anything on the bottom line, and they're being assigned these insane valuations. So again, becomes a situation of like, well, how do you deal with it? For me, at this point, I would much rather look at the psychology behind, the Fed bailing people out, and, inflows and outflows of cash in certain sectors in the market, and, who's getting margin calls and who's going to blow up. And, those kinds of things to me dictate the ebb and flow of the market now way more than the fundamentals, which is unfortunate because I'm a fundamental investor. When the Dow got down to about 18,000 and the S&P was 20, what did it get down to, 22 and change, or it got 21?
Right around there.
And it got down to 2,000 almost, right? Or 2120, the
I
low.
believe, yeah, it was right around there.
When we were right about at the lows, I was on the phone with my mom and I said, if we move 10 or 15% lower from here, I think it would be a spot to come in and buy staples. And I had actually started to nibble on a couple of staples. And I'm talking about Lockheed Martin. I'm talking about Raytheon. I'm talking about Disney, Nike. I mean, your dividend paying staples. Not because I think that they're priced cheap relative to their earnings, because I don't. I mean, but for different reasons. Because I felt like they were only going to let the market go so much lower. And I mean, before whatever the next step was, they did the QE Infinity after they had done the repo facility, after they had done the emergency rate cut. But, I still think they could come in and say, all right, we're going to buy futures. We're going to do this. We're going to do that, whatever. I think that's possible. I didn't buy those companies because I thought the price to earnings ratio was low enough for me to buy. I bought them because I felt like, first off, as Mark Spiegel says, look, at hyperinflationary environment, everything goes up, including stocks, right? So there's one reason. But the second reason is, they're brands that have been around for a really long time. Like Raytheon and Lockheed Martin are basically subsidiaries of the Department of Defense for the most part. And then you have, your Disney, your Nike, your Apple. I mean, these companies aren't going anywhere at all. They're really one of the only places you can get any kind of yield now, regardless of whether or not you're getting a price to earnings value or not. And I just think that the Fed will put a bottom in the market. I don't think it'll go, significantly lower. But my goal was take a little bit when the Dow was around 18,000, 18,500, which is where I started to nibble a little bit. And then if it had gone down to 16, 15, maybe even lower, I would have started to scale in with a little bit more, which I didn't wind up doing because the market ultimately started to bounce back. Now, what I'll say is I have those positions against a lot of other positions. I have a lot of hedges on. I'm definitely overweight gold and silver. So my main goal when I invest is to protect against exactly what the Fed is doing now, which is destroying the purchasing power of the dollar. And I think that's the most important thing to kind of be cognizant of. I'm also short a significant amount of stuff too. So I buy these long positions against a short book. I'm never like 100% net long or 80% net long. My personal PA is usually net neutral, or if you figure in the gold and silver positions, the reason they're in there, net short maybe a little bit. But I thought there was some opportunities like American Express, another company, like trading at $70 a share. It's, I'll take some companies that I would have liked to have owned if I had the chance to buy them at that price.
Right.
Reliable companies, whatever. Again, it's game theory on game theory on game theory. It used to be, hey, this company's generating a lot of cash and it's trading at 12 times its future cash flow, and I think that it'll be able to grow earnings for 15 years instead of 12. So I'll buy it now because the price intrinsic to the stock price now, or the value intrinsic to the stock price now, is underpriced compared to what the company will earn. That used to be what investing is. If you read what Buffett says and Benjamin Graham and all that shit, but it's not anymore. It's this psychological kind of alternate universe where you have to account for what the Fed's going to do, and you have to account for the fact that you can't get yield anywhere else, and you have to protect against hyperinflation. So those are some things that I started to buy in tiny pieces. And, it's like, look at Slack. Slack's a perfect example, right? I was buying Slack on its little earnings dip that it had at $16, $17 a share. Today it's up to like 27, 28, 29. That has nothing to do with the amount of free cash that they're generating, and has everything to do with the fact that the narrative is people are going to be working at home. So that product could be taking off at some point, and they could bring on a lot more business. And also, I think that they could probably get acquired. So if some, shit can company, like say Tesla acquires Slack, okay, you have a company that is being priced at a ridiculous amount and has $120 billion valuation that it doesn't deserve. Maybe it issues stock to go out and buy Slack, just on a hypothetical, for $40 a share, whatever. Does it matter that either of the companies don't make money? Does it matter that they're not priced relative to what their earnings are? No, it doesn't. It's just like fiat. It's like comparing the dollar to the euro. It's like, well, both of them are backed by precisely fuck all. So how can you measure one against the other? And that's basically what you're doing here with stocks. You're betting on stuff that's overpriced anyway, in the hopes that you'll be able to sell it at a higher price. It's like speculating almost.
Well, it
Because
is. I think it is. And that's how I define things. And I try to just allocate just 10% of my portfolio to buying something that I think is going to go up, with the other 80, or the 80%, the 10% goal, but then the other 80% an investment, which I would define as something that pays me to own it.
Right.
So on that note, and because I look at things that way, I'll most likely miss this entire opportunity. I'm sure I will, because I look at things the old school way, the way you're talking about, where I'm just looking for something if it's cheap, historically speaking. And if it never gets cheap, then I never buy it, and I miss the opportunity. But what do you think of the oil space right now, and Exxon, Chevron? Do you have any opinions on those?
I don't know who had the quote, though, just to go back to what you're saying, probably Buffett, but they say like investing is you're standing at home plate and you're just waiting for your pitch.
There you go.
And
Exactly.
you don't have to swing. The good news is that pitches keep coming. You know what I mean? So if you don't find something that's cheap today, you might tomorrow. You might not find anything for 10 years that you think's cheap.
Right.
So you buy when you think something's cheap. The other thing too that I have put a little money into that I didn't mention is some real estate investment trusts.
Really?
Super stable ones. I think real estate may actually get knocked around here a little bit.
What are the underlying assets of what you're buying?
But just like very reliable commercial property, just AAA rated names. Really, like I've been buying things like the VNQ, which is the Vanguard REIT, which is just a very low cost REIT to own. I think on a broader scale with real estate, I'm not out there buying Simon Property Group. I'm not buying malls,
Yeah.
But I think from a bird's eye view, what'll happen is I think real estate may get knocked around here a little bit as we continue to see deleveraging and this Fed spare tire works its way in and out of the system. But then I think ultimately there's going to be a tailwind coming out of this, with these 0% rates and the unlimited QE. I mean, I think it's going to be very inflationary. And I think asset prices, real estate prices are going to go up, just like I think stocks are going to go up. It's crazy because people think that like when you say that you're skeptical of what the Fed's doing, they assume you as a bear. So they say like when the market goes down, like, oh, like you were right. And when the market goes up, oh, you were wrong. Like, oh, they always assume you're short the market. Right. And it's like you can be skeptical of Fed policy and what they're saying and understand it and want to kind of play around it. I consider myself a bear, I guess. So when it comes to this stuff, I unfortunately consider myself a pessimist. I'm not like that in life. But I think that the Fed's doing itself a huge disservice. But in a case like this, where you recognize a situation where you think there's going to be significant inflation, I mean, I think it's okay to try and use that as a tailwind and try and have that behind you a little bit. Even though I think ultimately we're going to wind up in big trouble, which is why the majority of my weighting, and if I had to do it in my head, I would probably say it's 15 to 20% is in gold and silver at all times. And I'll be a buyer of both ad infinitum, which is Latin for all the time, forever.
Yeah. I had a conversation with Jeff Snyder the other day and Brent Johnson, and they're both kind of known for being, I don't want to use the word bullish because they actually get offended by that word when it comes to the dollar, but they think the dollar is going up short term. So I think they're kind of in your same camp where they're very bearish on the fundamentals of the market or of the dollar, but they still see that market potentially going up in the short term and being an opportunity. But going back to inflation,
because they think everybody globally is just going to pour into the dollar, right?
Well, that's one component of it. And then if you look at the way, I don't want to get off on a tangent here, but if you look at the way money's created and destroyed, if you look at the way money is created and destroyed through the banking system, issuing debt in and outside of the United States, there is, especially velocity slows down. There's a way for the lack of supply of dollars outside of the United States because of all the dollar denominated debt. And then you have the transfer mechanism for those dollars getting outside of the United States being imports. Because as you know, we import goods from China and we export them our dollars. Well, if all the supply chains are broken, we're not exporting those dollars. There's fewer dollars outside of the system. There's less dollars to pay the debt. So the value of those dollars increase. So, and then there's no more dollars being created because the euro dollar system is broken. So you have this situation where the debt outside the United States denominated in dollars is being paid off. If debt's paid off, you're reducing the money supply.
Right.
And so that's kind of the premise for their view. But they're looking at when Brent or Jeff says that they see the dollar going up. The problem is most people associate that with just the dollar is getting strong. But what they're talking about is a lot different than the way most people see it, in the sense that they're comparing it to other currencies.
Sure.
So the dollar is getting strong against the euro. It doesn't necessarily mean that the dollar is getting strong against apples at Whole Foods, right?
Right. Well, yeah, that's the deal with fiat, right?
Gas.
Like,
right. So
exactly.
So you can have the situation where the dollar is getting strong while at the same time local price inflation for consumer goods and services on healthcare, your rent, the groceries you buy, those prices are actually doubling, tripling, who knows? So what I wanted to ask you is, when you talk about inflation, how do you compartmentalize that in your mind from the standpoint of consumer price inflation and asset inflation, or do you see them being one and the same?
Well, I mean, I think of inflation as expanding the money supply, right?
Okay, Austin.
And right, and surprise. And and the Fed sees inflation as prices rising, right? So we're on kind of different. I'm looking at the purchasing power of the dollar, right? So I think you're right. Look, on a fiat system, it's like a bunch of horses running around the track, you know, and as one horse gets in front of the other and then backs off a little bit, and then, you know, comparatively speaking, one's getting stronger and the other one's getting weaker and whatever, but they're really kind of all just moving together, you know, the euro and the dollar, and I mean they don't have anything backing them. And I mean, even some countries, Canada, I know is a petrocurrency, and you know, when you're dealing with fiat, look, a great way to measure the strength of the dollar is against gold, right? Because all an ounce of gold is, all a gold futures contract is a price of an ounce of gold, which is always going to be an ounce, and the supply of gold is always going to be finite on Earth, whatever it is, right? There's some that we haven't dug up out of the ground yet, but we're not, you know, unless the asteroid comes and hits the Earth, we're not getting a bunch of extra gold at some point. So the supply side of the equation is capped, right? Which is what makes it a fabulous instrument to price in dollars, because you really get to see the dollar get weaker against gold as gold prices rise. So everybody that argues for the hyperinflation argument, that's why they're not going out and buying fucking Swiss francs, or going out, which by the way actually is the currency that if I had to own one, I wouldn't mind owning the Swiss franc. But that's why people that are trying to hedge against inflation aren't going out and buying the yen, or going out and buying the, you know, whatever. If you wanted to buy a fiat currency, you could go out and buy like the Kuwaiti dinar, or like, you know, something that's backed by oil, or you know, like you said, the Swiss franc, where you know that they're responsible with their money for the most part, comparatively speaking to other countries in Switzerland. But when you see the gold prices rise, all you're looking at is that same 1 ounce of gold. You're just watching the purchasing power of the dollar decrease. So no matter what the dollar does against the euro, like you're saying, that's not going to prevent it from, you know, that's not going to prevent the price of an apple from going lower. If the dollar gets stronger against the euro and they're both moving in this inflationary circle together, and one happens to, you know, prices happen to rise a little bit more in Europe than in the US, and then vice versa, you know, that doesn't actually mean it's getting stronger. The strength of the dollar comes from the purchasing power. It doesn't come from, you know, it's the dollar index, which I think compares it against a basket of other fiats, right?
It does, yeah. Yeah, it does. So talking about a limited supply of something, and I don't know if I've ever heard you talk about this, but what's your opinion on Bitcoin moving forward?
Bitcoin is interesting. I own a little bit, and I just there's things about Bitcoin that I can't get my head past. Like, what happens if all the power goes out? I always bring up that example.
Sure.
You can't access it. Your phone dies, whatever, nuclear holocaust. I know we'll have other problems to worry about at that point. But when it gets down to brass tacks, if something awful happens and I lose power at my house, and people say, "Oh, what are you going to do? Get your gold and walk around with it?" Yeah, that's exactly what I'm going to do with my guns, too. I got a bunch of ammunition and a bunch of guns, and I'm going to get them and my gold, and I'm going to throw them in a bag, and that's it. And I'll be able to reach out, and I'll be able to touch it and whatever. And my Bitcoin, if I don't have a place to plug my iPhone in, is going to be completely inaccessible. Now, with that being said, Bitcoin is still very interesting because with the way that we're printing money, anything that has a finite supply, even if it's a couple of lines of code, becomes very interesting because as the dollar loses its purchasing power, things are just going to have a tendency to fucking rip in terms of price at some point. The fact that Bitcoin is touted as a safe haven and as a store of value, both of which are up for argument that, I don't really want to get into, but because I don't have a super strong opinion on it, but it's certainly going to be interesting to watch.
Yeah.
I think it suffered the same fate as gold here over the last month or two, where people were just looking to liquidate anything that they could, right? So as the market's plunging, people are getting margin calls, and they got to get rid of whatever they can get rid of, and it doesn't matter if it's gold and silver or Bitcoin. So I'm watching gold crash $7,500 a day. I'm like, this is fucking great. I'm trying to order all the gold that I can because I know coming out of this, once the market stabilized, I knew that gold would start to take off, and that's what we're starting to see. And I believe gold's going well through $2,000 this year. Bitcoin is similar. You've seen some capital inflows back into Bitcoin now as the market has started to stabilize. But what does that mean? Ultimately, I don't know. Another big looming threat, I think, for Bitcoin is this. In this CARE Act that they're signing, they're talking about creating a digital dollar. If the United States makes a digital dollar, which, by the way, of course, is already the worst idea in history, if that happens, I mean, we already have a digital dollar. They print money by just, remember Bernanke said we just move a couple of fucking zeros on the screen.
Digital dollar is way worse, though, Chris. Way, 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 way worse.
But if that happens, I think they'll put the screws to Bitcoin. And I think that it will be a global effort to put the screws to it. Now, again, you could argue that that'll make Bitcoin stronger. If every government in the world comes out and bans it, who's to say that Bitcoin doesn't go to $200,000 a coin on that? I don't know. It's wild and it's unprecedented, just like the market itself. And I don't really have a prediction.
So when you talk about gold going up or it being 15% of your portfolio, 20%, do you think you're going to make money in nominal terms on gold or in real terms?
Just mostly nominal, because what I'm looking at it for is a preservation of wealth for the most part, right? So as the purchasing power of the dollar declines, gold should rise accordingly. And so I'm not expecting to get paid this huge premium on it, although I do think there will be opportunistic points, especially like with some miners, where you will get a premium associated with them and everybody kind of piles into gold all at the same time. You'll get some disconnects where gold will be priced at a premium, maybe to whatever. But mostly I see it as preservation of wealth. I think maybe in silver you have more of a chance of getting preservation of wealth plus a premium on your investment, given how out of whack it is with gold right now. But again, people that look at those ratios, the gold to silver ratio, and argue that, they should own silver because of that. There's another one somebody sent me the other day. The gold to oil ratio is completely out of whack. Well, gold's got to come down. Gold's got to go up, or oil's got to go up. One of the two has to happen. I said, nothing has to happen. Just because you're making the biggest spiked line on a chart somewhere comparing two commodities doesn't mean there has to be elasticity.
Right.
Who's to say that the Saudis don't stick it up our ass for another 20 years with oil and try to drive the price down to 8, or 5, or people are saying negative cost for oil because then you got a cost to deal with it and carry it. Yeah, so we don't really know. I'm not one of those guys that say, oh, this has to bounce back, whatever. But I think comparing gold and silver, which one you have more of a chance to preserve your wealth plus make a premium on? Maybe silver. I own them both. This way I don't have to think about it. You know, then I just know I got them both. I can go have a beer and mingle, and then I don't really worry about it.
Problem solved right there.
And let me just tell you something. If you own gold, if you own precious metals, and you watch this unfolding, right, with this unprecedented stimulus, and Neil Kashkari on 60 Minutes, like a total fool. We have an infinite amount of money. Like, what an idiot, you know, like just an unconscionable thing to say, right? Even if that's the truth, you don't come out and say it like that. You say we're going to take measured steps and that, you know, we have robust tools at our disposal. You don't come out like a 14-year-old go, we have an infinite amount of money, you know, like it has the reverse effect, like many Powell press conferences where he come out and tried to reassure the market. Every time they fire one of these bazookas, the market gets demolished because it looks like the Fed panicking. But these guys, they don't have the wherewithal to understand the game theory of this past more than one dimension. You know, the market's playing chess. These guys are playing checkers. Anyways, what the hell was the question? Sorry.
I know you kind of with your job, you're always cognizant of what's going on with CNBC and kind of the financial media. I don't really watch it at all too much other than just some YouTube clips here and there. But I think I was watching a YouTube clip, or maybe I heard it on a podcast, but I heard what Ackman did. They had him on for like 2 hours the other day. And I mean, he was just getting emotional and talking about buying hotels. And I mean, you know that game so much more than I do. I wanted to get your opinion on that. And is he just going out there and talking his book, or is he just really having a breakdown on national TV? Or what's your opinion on that?
Well, I watched that whole interview, and I've known Bill for years because when he was doing the Herbalife thesis, I similarly hated Herbalife. So anytime I would find a nugget of interesting information or whatever, I would email him, or Whitney Tilson introduced me to him 5-6 years ago. Back when he was doing that thesis. A lot of people think like, oh, I helped him out or we worked on it together. None of that shit happened. I was working on it kind of separately after he did his presentation. I couldn't believe Herbalife was still a company at the time. I didn't even know that they were still around. I was like, this is ridiculous. This company was an obvious pyramid scheme 10 years ago. I don't understand. So we kind of got involved and we got to know each other there. I think in this case, I don't really know. I think he's genuinely concerned to some degree. I watched the interview. I don't really know what to make of it. I know that Bill is an exceptionally passionate person. A lot of people think he's arrogant. A lot of people think he's sanctimonious. I can understand how people would think that. I think he's a little misunderstood. I think he's an exceptionally passionate person. Just in my limited, discussions with him talking about Herbalife and other things. I think that he was genuinely worried about his father, which is what he was talking about. His father is immunocompromised, I think has a lung issue. I think it hit probably close to home with him. I think that, he was audibly upset, and the market realized that too, and the market sold off big when he was on. He wasn't on for 2 hours. I think he was on for like 45 minutes with Wapner. Yeah. And
but then he's saying he's buying. He did say at one point, he was like, Hilton is going to zero, and then he's like, we're in the market buying Hilton today. Yeah. I think I don't really know what to think of the guy's trading. I really don't know. I know that he was hedged going into it. He made money off of his hedge. This was all publicly reported. And that he sold off his hedge and then turned around and went full on bullish, I think, a couple of days ago again. With regard to his trading surrounding that day in the interview, I don't have a fucking clue what the guys are doing over there at Pershing Square. Like they could have been selling into it. They could have been buying. Nothing could have been happening. He could have just been talking and just really been upset. I think at some point when he said, if this continues, Blackstone's going bankrupt and all this other thing, I actually think some of those are good points. If we weren't backstopped by the Fed, I think there's a chance that a bunch of shit could go bankrupt like he was talking about. And then at the end of the day, he comes out and he apologizes to Blackstone. He says, oh, maybe I was misunderstood. Oh, and by the way, we were buying some Blackstone. I don't know if that was the case. I think maybe he got a phone call from Blackstone and was like, why the fuck did you say we were going bankrupt on national television?
I don't know. I don't really know. I think Bill's an exceptionally passionate person, and I think he's very I think he gets very focused and very obsessed on something when he's involved in it. I don't know. All I know is this, George. In January, you were one of the only people talking about this thing being a big deal, okay? I could count on two hands the amount of people that I heard that were taking this thing seriously. And me and you did a podcast back in January. We were on your show in January where we talked about the zero hedge ban and we talked about the possibility of this coronavirus being a big deal. And I can count on two hands the number of people that said jack shit about it in January. Ackman comes on and says, oh, I had a vision in January. Nobody said shit, okay? He didn't say shit about it publicly in January. Nobody said shit about it. And the only people that said anything about it are not getting appearances on national media. Who's getting appearances on CNBC? Everybody that was on getting it wrong in the months prior to this happening. Okay, so everybody that normally goes on CNBC, Novogratz, fucking Stephen Weiss, this guy, that guy, the other guy, they get unlimited airtime. Not one of them said, hey, and I'm not even just talking about in January, in February. This was a huge deal globally in February. There wasn't one person on the network that said maybe we should keep one eye on this fucking epidemic in China. Right. Maybe we shouldn't trust China. Not one person. And instead, they drag out all the people that missed it and they have them on. And then I have to, after the market crashes, okay, then I have to read blog posts by guys like Josh Brown saying nobody called it. It's like, no, people did call it. Nobody on your network called it. You didn't call it. That's the problem. Yeah. So
I've got videos not only with interviews with you, but with Eric Townsend, who just nailed it, bam, bam, bam. But then also I did videos way back in January on if it did play out, how it most likely play out throughout the economy, and that the markets would collapse, the Fed would come in and do all this. It's pretty much played out just like that. But I don't want to toot my own horn here with our time. What I do want to ask, Chris,
if the listeners of this show wanted to go back and listen to a George Gammon podcast from January that you're talking about, which one would they go listen to?
Well, the very first whiteboard video that I did around this was, I believe, January 20th, where I outlined if this could be, I forgot what the title was, but if this could be a black swan, and my conclusion was yes, 100%. And if it was, this is how it would most likely play out in the U.S. economy based on what was happening in Japan, what the Fed reaction would be, and it's just pretty much what's happened. But that's one. But I've got probably 4 or 5 videos that I've done, not only whiteboard videos, but interviews with guys like you that really were just paid attention and did the math.
That's right. You're not an epidemiologist. I'm not an epidemiologist or an immunologist with a PhD. That's not what we do. But we're just using our brains. We just got to turn the fucking switch on and just use them. And that's in this instance, that's all you needed. All you needed to know was that, hey, sometimes China lies, okay, given their track record. They're saying that this has only affected X amount of people, but the measures that they're taking there, for instance, one day I saw them filling a brand new multi-million-dollar tunnel with dirt, okay, a tunnel that they had just constructed with dirt. They had dump trucks, they filled it from the bottom to the top with dirt. I'm like, that is a pretty drastic measure. You put a couple 100 million people on quarantine, maybe the wheels start to turn and say, this could be a bigger problem. And by the way, because it's a virus, and especially because at that time we didn't know how contagious it was, we didn't know if it was man-made or not, we didn't know what the true fatality rate was. We have a lot more data now that it's out of China. But maybe given all those things, we want to pay a little bit of attention to this and possibly start to discount things a little bit differently, because the virus doesn't care what day it is. The virus doesn't care what the Fed does. The virus doesn't care what country it's in. None of that matters to the virus. Virus is going to do whatever it wants to do. Yeah. And, at the time...
I think what a lot of people are missing now, they're assuming that, okay, well, once we get the R naught value down to, let's say 2 or something like that in the United States through social distancing or however they think it's going to happen, and we get it under control. Well, okay, that's great. I sincerely hope we do. But then what? Like, you're still, like Singapore as an example, like they really got it under control. They did what they needed to do with testing, but now they've opened up flights. So all these people are coming in from all over the world, reinfecting their population, and they're seeing growth now. So, I mean, there's so many logistical issues with the economy that people just really haven't thought through. And I obviously, I hope that from a health standpoint, we get this under control rapidly. But even if we do, I see it having very long-term consequences for
Sure.
the developed
And
economies in the world. It's not going to be this type of V-shaped thing where we spike back. We might spike back up to 30,000 because of the additional liquidity, to your point, but
but
the economy is
economic
not going to
activity,
go.
right?
Yeah, it's not going to get back to where it was.
And
Hey, one thing I want to go ahead.
people are in denial, George. People are in
Yeah,
denial about
I know.
this. Okay, you're saying Singapore is now letting people fly in. They think once it's contained, it's contained, and the answer is it's not. You can just as easily fuck up all the steps that you just took to contain it by thinking that it's okay to go back
Yeah,
to business as usual. And this is the stuff that we were talking about in January and February when we were watching flights in and out of Beijing, Shanghai, Wuhan, to all these other countries on the daily. And Trump comes out and says, oh, I implemented a flight ban and whatever. All you had to do was go on flight trackers. There were thousands of people coming and going from China every day. And if they said they found it in December, I say, let's talk about October or November. And then you start thinking about people going back and forth for holiday from U.S. universities and things like that. Personally, I'm of the belief that it's been here in the U.S. for longer than we think it has been. I think it's probably been here for, a couple of months. As a matter of fact, I had a fever and I was short of breath and had other symptoms back in January before all this shit, became a big deal, like early January. I never even thought twice about it. And it wasn't until like a couple weeks ago I was thinking like, is there a chance? Well, yeah, there's a chance. There's a chance this stuff could have been here running rampant on college campuses and other places months ago. And now
yeah,
the testing, we're just kind of highlighting the people that have it now. We're not tracking it in real time, right?
right. Yeah, and someone's rebuttal to that, Chris, would be, well, you see, Chris, it's already throughout half the United States population or 10%, and it's no big deal, so we don't have to worry about it. And that would mean that the case fatality rate was extremely low based on the death count that we have. But what that view doesn't take into consideration is the fact that we have a limited capacity of ICU beds and ventilators, and the hospital system can't scale with the virus. So let's just say the virus has the same death rate as the flu. Let's just say that it's the exact same, right? Well, still, it overwhelms the hospital system because if we have a double flu season or a triple flu season, let's just call it that, where an additional 20 million people get a virus,
Right.
and X amount of those people, even if it's a very, very low percentage, need hospital care, they're not going to be able to get the hospital care. Then your case fatality rate goes from, let's call it 1%, up to 5%, up to 10%, because people who otherwise would have been saved, now they can't be saved because there's just not the equipment to do
Right.
so. Also, people don't take into consideration, well, how many people are going to have heart attacks during that time frame? How many people are going to get hit by a car? How many people are going to cut off their hand or something, right? Well, those people they're not going to be able to receive the care, and then your death rate on all the other things that happen within a society, that's going to go up huge as well. So that's really the problem. If our hospital system could scale at the exact same rate as the serious complication rate of the sickness, then there's no problem. There's absolutely no problem. Just
You
get
also
on
have to take into account the number of people that are going to the hospital now that this has become a headline versus, let's say it was here in December and nobody knew what coronavirus was. you'd be more inclined to stay home and try and treat it yourself and just think you have the flu. So in
Yeah.
addition to what you're saying, now everybody that has a cold or everybody that's got a flu, in addition to having coronavirus, is now going to the hospital as well and putting pressure on the hospital. My friend
Yeah.
says, one of my buddies said to me, I was arguing this point that it may have been here for months. And he said, well, how come the hospitals are only being overwhelmed now? And that's part of the reason is I think people are far more inclined to go to the hospital now. Whereas in the past, they may have just thought, hey, I just have a cold or I just have a very bad flu when, it was actually coronavirus.
Yeah. What we should have done initially, and this would have solved the problem of the economic, balancing act you're doing with saving lives and destroying the economy. If we would have just tested everyone right at the beginning and then isolated the people that are sick and try to find out the common denominators. Is it obesity? Is it smoking? Is it age? Is it male, female? Is it diabetes? Let's isolate what's going on here. So now we have all the data and we can realistically say, okay, people in this group, you're good to go. Go outside, go back to work. Let's start the economy. Wear a face mask, practice social distancing. Now, with this group, you need to be isolated. So we could really get finite with our approach. Then what you're doing is, yes, the economy comes down a little bit, but you're not completely destroying an economy, which, by the way, was already severely broken. But one thing I want to get your opinion on. And this is something I wonder a lot, can you explain quickly what happened with Robinhood? And then my next question after that would be, is there a risk? Do we have counterparty risk with the TD Ameritrade or wherever we have our brokerage accounts for actually, putting $50,000 or $100,000 to take advantage of these stock opportunities you're referring to? Is there counterparty risk there we should be worried about?
Yeah, that's a really good question. Because it's something that I think about as, somebody that's a little paranoid and a little skeptical of the system. I think about it all the time. So for people that don't know what happened with Robinhood, Robinhood is a retail brokerage that is an app that you download for your phone. I don't know if you can do it on desktop now, but you used to not be able to. And they were the first brokerage to offer free trades. And so they brought in a lot of business from there and they let you trade just using it's a very retail friendly app. And on the days where we had unprecedented volatility, people weren't able to access their funds. They weren't able to make trades. They weren't able to close out trades. They weren't able to open new trades. The server, whatever, was overwhelmed. Some people said it was a coding glitch. I don't know if that's true or not. But there's a risk right there. And it's not just Robinhood. It's Ameritrade also, too. You can see behind me, I have Thinkorswim. Ameritrade isn't it's not, the account that I use all the time. But I do have an account with Ameritrade. And there has been issues over the last 2-3 weeks, especially at the very beginning or the very end of a trading day, where I haven't been able to access my account. I haven't been able to place trades. I haven't been able to sell things. I try to take an offer and it won't take, so I'm not getting fills on offers that are there, or I try and sell into a bid and I don't get taken out, or I've been watching companies that have a bid-ask spread that's the same. There's all these weird things going on. And that's something that people need to be very aware of, especially, I did a whole Periscope talking about the risks of if the market closes. Right? Mm-hmm. Make sure you don't have options that expire near term, things like that. There's other risks here that I think people need to be cognizant of. For instance, one that I've experienced personally is if you trade weekly options, there's a lot of crap that floats around on a Friday at the end of the week as it's getting ready to expire that you need to make sure it doesn't go in the money, doesn't trigger a huge buy or sell block in your account, things like that you have to just kind of keep an eye on. And if you're trying to wait until the last 10 minutes, 15 minutes of trading to get rid of something, to exercise something, or to buy or sell an option, whatever, close out an option position, and you can't do that, sometimes you get stuck with crap after the close on a Friday, and then you got to make a phone call and sit on hold for 2 hours with Ameritrade and then talk to some guy that hates everything because he's been talking to people nonstop because the platform's been fucking up all day. And you got to apologize to him and say, hey, I'm sorry. I tried to execute these trades on my own, but I couldn't. Last week was another perfect example. I tried to put a sell in for an options position. I forget what it was. It's probably SPY options, right? And I think I had whatever it was. I had bought them at whatever. Let's say I bought them at 10, and I had put in I think I bought 100 at 10, and I immediately went to put in, and the market was moving very, very wildly at the end of the day. I think it was falling. These are probably SPY puts. I think I bought them at 10, and I put in an offer to sell 50 at 45 cents, or I put in an offer of 50 to sell at 75 cents, and then tried to make a second half of an offer to sell 50 at 45 cents. In essence, so that they would just get taken out if the market flashed downward instead of me having to go in and actually execute the trade. So I bought them, and then I tried to immediately put the sell order in. I put in the higher end of the order, the first 50, I put in the offer to sell at 75 or whatever it was. Then the second half of the offer, I tried to put in, and it wouldn't let me put it in. It was coming up as some kind of, error. So then I tried on Thinkorswim, and it didn't work on Thinkorswim. Sometimes if you use the website, that doesn't work. Then you got to go to Thinkorswim. If that doesn't work, sometimes I'll go to the mobile app. That'll work sometimes on the other side. Nothing was working. Meanwhile, in the interim, and this is my own dumbass fault for trying to do this at the end of the day on a Friday, but meanwhile, in the interim, the price that I wanted, the lower end of the price, the 45 or whatever it was, had gotten taken out, but I couldn't get the order in, so I didn't get a fill on it. And then ultimately, by the time I got somebody on the phone, it was an hour later because the thing just stopped working at the end of the day. And I try to explain to him, like, I'm trying to put this offer in here and I didn't get a fill. And I know he's going to tell me there's fucking nothing he can do. Like, what's he going to do? Take me on my word and fill the offer for me? He'd have a million assholes every day saying, I didn't get the price I was trying to sell at. And that's what he said. He said, he can't do anything. And I said, all right, well, now I'll be cognizant of that risk going forward. And I didn't tweet about it or anything, even though I was a little annoyed about it. But now that you mention it, it's a proper time for me to bring that up out of nowhere.
Yeah, so there's counterparty risk there and just getting execution on trades. But is there a risk of them going out of business and them losing your money? Or is it FDIC insured? Not that that's really... yeah, exactly. But what would the average person do if they were really worried about that type of counterparty risk?
Buy and own physical gold. That's what they would do. If you're worried about counterparty risk, you make yourself your own counterparty. I've got gold. It's buried in a safe somewhere, and I got a lot of guns to protect it. So not saying that that's going to happen because I think, the Fed pretty much has an unlimited backstop in terms of backstopping the banks and things like that. I don't think the Fed's going to let, any type of huge major, even though it should, I don't think that they're going to, and they may destroy the dollar in the process and destroy the entire U.S. economy in the process. But I worry less and less about that now, but I do worry about it. I worry about counterparty risk way more than the average person. I'll tell you that. And it's just another reason I try to stay diversified. If you own property, if I go and buy a condo somewhere, I don't have to worry about counterparty risk. I own the deed, I own the title, it's mine, and that's that. So there's some invested money where I don't have a lot of counterparty risk. If I buy some type of, option on a future, on a soybean contract on Ameritrade, then I got 5 layers of fucking counterparty risk, right? Like all this shit that's happening with gold. I got the guy that might not show up with the soybeans if I want him to deliver them, Plus I got all the platforms. I'm going through a derivative of a commodity. So yes, you should try to mitigate counterparty risk one way or the other.
All right, buddy. Well, I sure appreciate your time. For the viewers who want to find out more about you, where can they go?
I'm just going to say this one thing. I'm not going to promote myself because I don't like to do that. But what I'll say is...
Well, I'll promote it. Go to QTR Podcast and check them out.
Shut up. What I'll say is that there were very few people that had the foresight to understand what was going to happen here with this virus. And you were one of those people. And I just want to say 2 things. The first is, again, you're not an epidemiologist. You're just applying common sense. And that's why I think it is so exceptionally important that you are doing what you're doing. And I'm so stoked to see your channel become so successful, because what people need to understand is if that can happen in this case, and George Gammon can be the smartest fucking voice in the world about it, right? And I know there were other people out there that predicted it, but you were the guy that was warning about it early. And all these guys that come out in the media and everywhere else, and the people at the Fed and the president, and nobody said anything. And the only thing you were using is common sense. If people don't think the same exact thing can happen when it comes to monetary policy and the economy, people think that you can't be right just because you're using common sense about those things, they're going to be sorely mistaken. You were just right about this. All you did was use the old fucking grapefruit on top of the neck. That's all you did. And with monetary policy and economics, you will again be proven right. That's why it is so important that you're doing what you're doing. And I'm so stoked to just talk to you and to know you. And I think that you're a national treasure. I really do.
Well, I appreciate that, Chris. I have to give most of the credit not only to the editors that work for me. They make me look a lot smarter than I really am. But guys like Eric Townsend and Chris Martenson, I was just kind of digesting the information they were putting out there and just kind of putting two and two together. But I think the takeaway for everyone, because I'm so, I almost flunked out of high school. I've never taken an econ class in my life. I've never taken a finance class. So if just the person of just simple average intelligence like me can observe and watch these things and put two and two together, every single person out there that listens to your podcasts or watches my YouTube channel can do the exact same thing if they're paying attention, and they can just use all of this information to connect the dots and be better prepared for their own financial future. And I think that's what's really exciting about it.
It's not even about whether or not you're of average intelligence. I mean, obviously you're brilliant. You're above average intelligence, right? But it's about whether or not you want to be an egotistical fucking intellectual snob or not. And I know that sounds kind of harsh, but you can't tell me that a lot of these MMT and Keynesian people and the people at the Fed, that they can't comprehend what we're saying. They can totally comprehend it. They get the argument that we're making. They get the Austrian school side of things. But their intellectual snobbery, this arrogance that they have found the model that is going to allow them to manipulate the economic system at will, the way that they want, that ego, that arrogance, that's the problem. And you don't have that. You don't have an ego, and obviously you're very smart too. So it's that difference. It's not just, a fifth grader could understand what you talk about, George.
Yeah, well, I hope so. That's the intent. But I think you hit the nail on the head, is that all these people with PhDs at the Fed, or that you see on CNBC, or the professionals, quote unquote, they've got their models, and if there's cognitive dissonance there, in my opinion, that if they are wrong, then their whole entire worldview is wrong. Their models are wrong. If their models are wrong, then they're nothing. And that's tough for someone to accept that's 50 years old, or has believed this in these models since day one, because that's what they were taught at Oxford or Harvard or wherever, where it's a huge advantage for someone like you or I, or just the average person out there, to not be so emotionally married to Keynesianism, or even the Austrian school for that matter.
Yep.
But we can just sit back and say, okay, well, what's common sense? And that's what I always tell people. Don't subscribe to the school of Keynesian economics or the school of Austrian economics for that matter. Just subscribe to the school of common sense economics. And it just so happens that usually that lands on the side of the Austrians. But
you're right. People get invested in
emotionally
the line that they've been carrying for 30 years, 40 years, 50 years. And this is a huge problem with academia in general. There's a lot of good things that come out of academia, right? There's a lot of, the PhDs, they make the world go round. They're really on the forefront of human evolution in many, many ways. But there are also some very bad sides to academia. And, a very dear friend of mine is a PhD at Penn. She's one of the smartest people I've ever met in my entire life. I don't agree with her on politics. I don't agree with her on a lot of things ideologically. But the one tie that bound us immediately was that she understood that those types of things happen in the world of academia. And that's what she has worked to kind of disprove, is this ongoing cognitive dissonance that happens. Like when you said, if you're a guy that has spent 40 years research, like if you're Paul Krugman and you've banked your entire career on saying that, what are you going to do? You're just going to wake up one morning and go,
I'm
no?
all wrong.
Right.
Everything I've believed in. Yeah, here's my Nobel laureate. Well, I'll give it back because all my models are wrong. And
I hate to go off on a very quick tangent, but it's like people that talk about the water erosion theory on the Sphinx. Okay, and I don't know if you don't have to know anything about this, but there's certain people that think that the Sphinx is a lot older than Egyptologists think it is. And one of the things that they cite, they have a geologist that cites these giant crevices in the stone leading into the basin where the Sphinx sits that look essentially like water erosion, right?
Right.
And they've taken this thesis, this geologist, Robert Schoch from Boston University, has taken this and tried to put it out there and just be like, hey, look, like the lines are going down. Like this looks like water erosion. Like he's got a PhD from Yale. He's a very smart geologist. And the Egyptology community, they will hear none of it, because if they admit that might be what it is, that opens a book to this fucking thing being 12,000 years older than has ever been written in any textbook. And while that may or may not be the truth, they don't even want to talk about it because they've spent their whole careers reading textbooks and writing papers and forwarding the narrative that, hey, it's X amount of years old and that's it. So no matter, it's like, who are you going to believe, me or your lying eyes, right? And it's the same deal with this economics thing.
Yeah, I totally agree. All right, buddy. Well, I'll give you a plug since you won't. Go to Quoth The Raven podcast on iTunes, Stitcher. Definitely follow Chris on Twitter. It's under the same Quoth The Raven. It's QTR Research, I believe, on Twitter. And Chris is just a brilliant guy, really funny, man. You got to do some stand-up comedy here and there. But you got some voices, man. Your Trump impression is second to none, and you got the Simpsons down pat too. So definitely follow Chris. And Chris, I appreciate your time. I can't wait to do it again, buddy.
Thanks. And George, you will be on my podcast very soon as well. So I'll be able to ask you questions and talk a lot less and hear what you have to say a lot more, which I look forward to.
All right, buddy. Thanks a lot.
Thanks, buddy. Speak to you soon.